Are you looking to knock 10 to 15 years off of your retirement time so that you can retire faster and enjoy more time with your family? If so, today's episode of Purpose Driven Passive Profits is going to explore how investing in passive multifamily deals can shorten that timeline for you. We're going to cover what it looks like, how it actually works.
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
Imagine if you would have been able to invest in a property in 2010 or 2011 and double, triple, or even quadruple your retirement accounts. If you have a 401k or an IRA that is sitting there, this is the episode that you want to listen to so that you can be a great steward of your money. His name is Nate Armstrong. He is the founder and CEO of Home Invest. More than 1,400 deals, more than 400 syndicated deals. My name is Steve Warner. I'm the Chief Investment Officer. You're listening to Purpose Driven Passive Profits. All right, Nate, let's jump into it. Long-term horizon for passive real estate investing in syndicated deals. What does this actually look like in a money standpoint? Can we just dive in? If people had like 100 grand right now in their retirement account, what would it look like if they invested it into a multifamily syndication deal?
Yeah. So 10 years ago, Steve, I had the blessing of doing exactly what you just said into 5400 Birdsong Lane. It's in Bokeelia, Florida, this little island right in front of Fort Myers, Florida. And I did a miniature syndication on it. It was me and one other person. And we bought this property, a little multifamily, for $61,000. Now I know when people hear that price, they're going to be like, what? That doesn't exist. But this is reality just a decade ago, 10 years ago. And if you fast forward to today and you look up the valuation on it, Zillow would say that it's worth like $350,000. So I bought it for $61,000. Today, Zillow is saying it's worth $350,000. Now, Zillow isn't always accurate, but for goodness sakes, like it's gone up a ton in value. It's more than doubled. It's more than tripled in value during that time. Same.
That's
Go ahead,
like
sorry.
a 6x. If you do the math, that's a 6x return on your money.
Yeah, insanity. And I'm not suggesting that every property is going to 6x in value. Like that doesn't happen, but that property actually did. Same window of time, same decade. We bought 1416 6th Avenue South in St. Cloud, Minnesota. Beautiful little 20-unit building. We got it for just shy of $500,000. And we sold it 2 years later. We didn't even wait 10 years. We sold it 2 years later for $1.7 million. So we bought it for 500, sold it for 1.7. We bought it for 492,000 exactly. And so multifamily real estate, it has the potential to build a lot of wealth, to build a lot of equity. So if someone comes in with maybe their IRA or 401k money or just cash that they have, and they stick it and they park it into one of these nicely underwritten multifamily properties, they can potentially do really, really well, at least on the couple examples I just gave you right there. Like we hit absolute home runs for our investors that partnered with us on those deals.
So, okay, let's talk about, you brought up 401ks and IRAs. If people are working in they're working in their day job, maybe they make, 100, 150 a year, and they have a solid retirement account building, but they want to invest in real estate. How does one go about doing that? When I heard this, I didn't even know that this was possible. Somebody had to educate me. So how does somebody move their money from a 401k or an IRA into a real estate deal?
Yeah. Yeah. It's not illegal. It's legal, 100% legal. Okay. So first step is that you have to move the money from wherever it is now. Usually it's with your employer in some kind of like protected account and tied to the stock market. You have to move it from that custodian over to a custodian that handles self-directed IRAs or self-directed 401ks. If you Google search it, you'll find a whole bunch of them out there. We, of course, have our favorite two, the folks that we actually entrust our funds to, our money, and all of our clients. If you'd like any help on that, just reach out to our team here in the office and we'll hook you up with the people that we use. But you find one of them, you show them what you're working with, like, hey, this is the 401k I have right now. Like for me, I used to work at Target Corporation. I had a 401k. I stacked it up for a while. It was stuck inside of Target. And then I worked with one of these companies to roll it over into a self-directed IRA. Once it was in the self-directed IRA, then I had checkbook control, meaning I could literally write a check and invest in what I wanted to invest. And so I started doing real estate deals with it then. So that's the process for that.
Okay, so just so you guys understand, this is a super easy, clean process. It's not something that's overly complicated. If you have questions, you can click down in the description below, or you can go to homeinvest.com where you can book with myself or Sue, our head advisor. Either of us can walk you through this, but it's a very simple process. And once you've done that, you can now invest your retirement account into real estate, whether that is with us in one of our deals or whether that is in somebody else's deals. You can invest it. And here's the difference. Stock market might pay out like 3, 4, 5%. An average syndicated real estate deal should pay you somewhere between 15 and 20% over a 3 to 5 year period. That's a 1.8x to a 2.2x multiple. So if you put 100K in, we always tell people our job is to get you 180 out in 3 to 5 years. If you do that 3 times, what does your retirement account look like versus the 4%? Yeah, I always looked at my retirement, Nate, like when I used to work for Vail Corp, I always looked at my retirement as that compounded interest scale, right? But the thing was that it was like a 30-year period before you really saw the hockey stick. If you do the same thing, but you plug in the numbers that we're giving you from real estate right here, you're going to see that hockey stick is a lot shorter. In 10 years, you could like 6 to 7x your money. So if you have 100K inside of 10 years, realistically, with 3 good boom, boom, boom real estate passive investments, you could be at over $1 million. That's what we want to get you to.
And I'm just going to help us come back to like conservative thought process too. I didn't mean to give an example to get people overly excited, because we like to under promise and over deliver here. Everything that Steve and I do, it's always under promise, over deliver. And so usually, like my mentor, he's done 3,000 buildings in his life. And I was having lunch with him once, and he said, Nate, all my buildings, they double every 10 years. And I'm like, that's too good to be true. I'm calling bluff on that. He's like, no, Nate, you look them up. I'll give you whatever you want. You look them up. He had his bookkeeper send me all the properties he's done on an Excel file. And I went through, I didn't audit all 3,000 of them, but I spot audited some of them. And sure enough, he was right. Most of them, everyone that I checked anyways, doubled every 10 years. Now, why? How? Well, because value of multifamily property is not driven by what your neighbor's property sold for. Unlike single family houses, if your personal house, like if you're sitting on there checking the Zestimate to see what it's worth, that's all driven by what the neighborhood is selling for, the average selling price per square foot in your neighborhood. Multifamily is not derived that way. Multifamily's value is derived by the rent income. It's derived by the net operating income, which means you increase the rents, you increase the value of the property. And so it's really simple. What happens to rents over time? And Steve, I know that you know that answer. And I think that anyone listening to us right now knows that answer. Rents, certainly, they're not going backwards. Not very often. Every once in a while, luxury rents do, but not very often do middle-class rents go down.
Well, let's actually dive into that really quick, Nate. We pulled this graph up at one of our last live events. In history, in recent history, like we're talking last 100 years, have multifamily rents ever gone down during a recession?
Only luxury rentals.
And what do we invest in?
C-class, working class properties. Working class properties. That's the solid one.
I just want to unpack this. If you're listening to this and you're new to real estate, this is like, and you're nervous about investing, luxury rentals are like the ultra premium, really expensive rents. And during boom times, they're full, but during bust times, they tend to pull back because people aren't going to spend money on them. That's an A-class property. A B-class property is like think about like a solid working class apartment, but with a couple extra amenities or like with everything like spotless and new. C-class properties are the properties that are normalized rents where everybody lives. They're nice, but they're not overly improved. They're in a good location. They're not in the best locations. They're in good, solid locations, and they bring in good rents. That's where everybody wants to live. And it's really interesting right now during this like start of the recession, wherever you think we are in the recession, we've seen this happen in Austin. We've seen this happen in Dallas. We've seen this happen in Jacksonville, Florida. We've seen this happen in Orlando. People are moving because they're all like, they're feeling that crunch of the economy. And they're like, okay, I don't need to pay to live in the nicest place possible. I just want to live somewhere safe that has all of my needs met. That is a solid C-class property. So you want to make sure when you are investing, if you want peace of mind, invest in a C-class property because they are always full and rents are always steadily increasing. They never go down. I won't say never, but 98% of the time they don't go down. They might plateau for a little bit and then they go right back up. Nate, did I miss anything in there?
No, you nailed it. You might see some stuff in the news about like Airbnb or short-term rental rates decreasing right now. That's reality. The short-term rental market got saturated. You might see in the news stuff about luxury rentals coming back down, or even a couple of select cities. It's not the nationwide trend though. There's a couple of cities that got a little bit too hot too fast. And then what happens, like Steve said, is they typically plateau. And then eventually a year, maybe 2 years later, you start to see the increase happening again. All of our multifamily right now, like, and we're talking 7 different states. All of our properties, we're seeing increases still. Increase. And I think it's during the recession, if history repeats itself, it will only be more of the same.
So Nate always likes to say that we go with the boring, quote, boring properties. We always we underwrite 400, 500, 600 deals to find one deal. And we find a deal that is normally a little bit under rent and is in a great C location where we can just edge those rents up. And that's one of the reasons that we have such solid investments. Our goal here is to help you guys knock 10, 15, 20 years off your retirement to get that retirement account up to wherever you need it to be to live comfortably. And we do that all through real estate. The last piece I want to talk about here with long-term investments, Nate, if they're new to this and they're thinking about it, but they're like, the stock market is so safe, or I need a safe place to park my money. Like it's $100,000, $200,000, $300,000 that I've been stacking up for years. How do I know that real estate is safe? Can we just talk about that for a second, Nate?
Yeah. You remind me, Steve, before I started heavily investing in real estate a long time ago, I just out of college, I invested a bunch of money in stocks into a company called Eagle Technologies, mainly because my landlord, who I respected, he had a bunch of rental properties and I listened to him. He put everything he had into Eagle. And no doubt, 6 months later, Eagle Technologies disappeared and my stock became worth $0. So all of the money I'd saved up during college, I put a big chunk of it in Eagle and I lost it all. And that's when I realized that the stock market isn't so safe. Okay. It's a roller coaster and it can go away at any moment. Real estate, on the other hand, even in the midst of a value degradation, like values going down like 2008, 2009, even in the middle of that, the real estate rents typically still go up. And so what does that mean? If you're looking for a safe play and you want surefire like dividends or rental income coming in every single month, real estate is the only way to go. Real estate doesn't disappear. Real estate doesn't go away. Even some of the crazy like hurricanes, fires, floods, tornadoes, you have insurance for those things. Insurance covers those natural disasters. So there's in no event that I can think of right here, right now, that you lose everything on a real estate deal, unless you did something stupid, like maybe you leveraged it with a bad loan or something like that. But we don't get into those kinds of games. But if you're buying straight up standard C-class cash flowing type properties, it's really hard to lose.
Awesome. If you guys want to hear about how to mitigate risk, if you go back to, it's either a previous episode or 2 episodes back, we cover the top risks that you need to mitigate when doing multifamily. And it all has to do with the questions that you ask the syndicator. If you would like to talk to us about our current deals, you can click in the links down below in the show notes, or if you're watching this on YouTube, it is there, or you can go to homeinvest.com/book. That will get you on with myself or Sue, our lead advisor. We'll talk to you about our deals. We can also answer any questions that you have. Our whole general thesis here is to help you follow the principle of stewardship laid out in Matthew 25, where it talks about don't bury your money under a rock. Instead, be smart, use the brain that God gave you, lean in, find good investments, and double your money. That's what we're here to help you do at Home Invest. You've been listening to Purpose-Driven Passive Profits. We'll see you next time here on the show. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Hey, accredited investors. I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
We'll see you soon here on Purpose Driven Passive Profits.